The Street opens lower as investors weigh the new tariff slap by Trump on goods from key trade partners and their potential impact. Mid-caps relatively underperform. Chemical stocks gain on the likely positive rub-off, while metals decline.
Meanwhile, the post-budget moves continue. FMCG stocks, Nestle, ITC, Nykaa, they climb as the government expects the union budget to drive consumption. On the other hand, the budget had no mention of LPG subsidies, putting OMC stocks under pressure. Capital goods also likely to face growth challenges, dragging stocks lower.
Hindustan Aeronautics, brain-based solutions under pressure after Morgan Stanley changes their focus list of stocks. On the other hand, we have Titan as well as M&M doing a lot better, along with Jubilant FoodWorks as they get added to the list.
Eicher Motors thumping ahead on the back of its January auto sales data. The company reports strong monthly sales, 4% higher than estimates.
UPL climbs nearly 4% after brokerage firm Investec upgrades the stock to buy from sell, raises its target price to 700 rupees from 450 earlier, citing the company should be able to bring down its overall debt levels in FY25.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. Hey Mangalam, market's a little bit under the weather, but I think it has more to do with regard to Trump's tariffs. So if you look at it from the morning itself, there are select pockets which are seeing buying and the markets are continuing to defend lower levels. So I'll take heart from that fact.
One would take heart from that. And also, the sectoral shift that happened on Saturday is continuing today with a lot more gusto. So we are seeing urban consumption names do a lot better. Case in point, something like Avenue Supermarts, which saw a big gain on Saturday, continues its gain right now as well. Jubilant FoodWorks, Indian Hotels and Zomato. All these urban consumption plays are doing a lot better. But let's talk about earnings, because not only did we have news coming in from the global front, we had news coming in from the budget. The earnings season is underway as well. Equitas Small Finance Bank, the bank saw its deposits rise 25% year on year, and the third quarter slippages too have seen a rise on a sequential basis. P.N. Vasudevan, who is the managing director and CEO of Equitas Small Finance Bank, now joins in to detail those earnings itself. Thanks a lot, sir, for joining in. Let's talk about your growth going forward, largely because your AUM grew by about 15% year on year. I remember the conversations that we had earlier. You had that 25% advances growth target. Where do you stand on that right now? And by when do you return to that 25% target?
Morning, and thank you for having me here. The growth for the 9 months has been 20% for the rest of the bank, and microfinance, which is 14% of the book, has actually been degrowing. It's degrown by about 11%, and that's why overall we have a 15% advances growth. The 25% that we had indicated earlier was at a time when microfinance was not seeing any kind of a stress, and microfinance would have grown, and the rest of the book also would have grown. But today the scenario is quite different, so we don't really expect the 25% growth to come in the very near term, but that's something that we should look at it from a more medium to long-term perspective. Right now, we are actually not guiding for the growth for this current financial year, but definitely microfinance will continue to degrow, which means that overall the bank's growth will be to that extent impacted.
Okay, all right. Hi, Mr. Vasudevan, and good to see you, Ben. But as the microfinance degrows, that's impacting your NIMs as well. As a percentage of your total mix, I think MFI has come down to roughly around 14%. So what is the outlook on the NIMs? And also, I recall the last time you joined us, you had said that you're expecting the pain in MFI to continue. How far are we away from relief?
Yes, so as far as the NIM is concerned, we had a 30 basis points drop in the third quarter, largely contributed by the fact that microfinance share of contribution has been coming down. Two things we expect to kind of support that in the next few quarters. One is that the micro loan against property, which we give for small business people secured against their house property, has shown a very good trend of growth, and the disbursement actually doubled in the current year compared to the last year 9 months. And from a yield perspective, micro LAP is kind of similar to microfinance. So as we kind of fill up that gap with more and more of our secured product, the yield pressure might come down over the next few quarters. That's one thing. The second thing is that about almost 80 to 83, 85% of our book is a fixed rate loan book. Only 15, 17% is a floating rate book. And so last year and the previous year, we had a negative impact when the interest rates were going up, and we were not able to pass on that to the existing borrowers because our books were fixed rates. Now, if the interest rate cycle starts turning and the interest rates start coming down over the next few quarters, our earnings may not be impacted because, again, as I mentioned, large part of the book is fixed rate. We might actually see the reverse effect, and that might again support the NIM. So I think a combination of these two, we think that in another 2 quarters, I think the NIM pressure should ease.
What should the NIMs look like in the near term from around the 7.3, 7.39%?
Yeah,
it might settle down around the 7% level.
All right, it'll settle down around that 7% mark itself. On your CD ratio as well as credit cost, you said that you'll have better visibility once we move into the second half of this year. What is, are we any wiser?
See, from a credit cost perspective, the rest of the book, which is our 86% of the book, the credit cost continues to remain very comfortable at around the 1 to 1.1% level. So we don't see any challenge as far as that is concerned. As far as microfinance is concerned, we had a 10% credit cost in the third quarter, largely contributed by the fact that our second and first quarter, there was a amount of slippage. See, in microfinance, what happens is it's a 6-month lag from the time you have a X bucket slipping into overdue to the ultimate period when the credit cost hits the book. It's a 6-month lag. It takes 3 months to become NPA and then 3 months for it to get 100% provided. So it's a 6-month lag. So our Q2 and Q3, our X bucket slippage was 98.2. At 98.2, microfinance continues to be a loss-making business for the bank. It has to reach a level of something in the range of 98.6 or so, at which the earnings and the credit cost will kind of even out and the product becomes a break-even. And when the X bucket goes to beyond that 98.6, when it goes to 98.8 or 9 or 99, that's when it comes back to some level of normalcy. So we have put in a lot of effort in the third quarter and second quarter, and there's been an industry initiative to also bring about some discipline in lending. And we are just hoping that, the fourth quarter and maybe the first quarter of next year should see an uptick on our X bucket. If that happens, then I think somewhere by second half of next year, things should try to come back to normalcy.
Okay, all right. Quick couple of points, sir, before we let you go. Your slippages, from around 500 crores on a quarterly basis, it's moved closer to around 600 crores. In the coming quarters, how do you see this number to move? And I understand that the problem is in the MFI basket. So how do you see things moving on a quarterly basis? Point number one. Point number two is as you scale up your non-MFI part of the book, the expectation is ROA will improve. So what is the targeted ROA?
Yeah. So as far as the gross slippage is concerned, there was an uptick, largely contributed by MFI. But if you see the net slippage for the rest of the book, the net slippage actually sharply improved in the Q3 because Q3 generally is a season of better season from a collection perspective, and Q4 will continue to be normally a good season for collections as well as business. It's an industry phenomenon. So we expect that the slippage should continue to improve in the Q4 and going forward.
All right, you expect situations to improve in Q4 and going forward. Wish you good luck, Mr. Vasudevan. Thank you so much for joining in and being so candid about the stress in the MFI business, but your points of moving away from that and improving your own business as well. With that, we'll step into a short break. On the other side, we have the management of another financial organization. Ashok Chandra, who's the MD and CEO of Punjab National Bank, joins in to discuss their third quarter numbers. Welcome back. The pain in the Capco's name continues to extend. So we have Hindustan Aeronautics, which is currently at the low point of trade. And also, other names like NHPC, we have Tata Power, all of them under a wee bit of pressure. A couple of stocks from the consumer space which are also not doing too well. We have something like a Colgate, which has moved to the low point of trade. Why is that? Because a higher proportion of their revenue as against the others comes in from rural India, and one of the growth push for Colgate itself was likely to be for rural India itself. Not that rural India is doing too bad, but the budget focus was more on urban, discretionary, middle class, etc., which is why the nature of stocks which are moving. So pull up something like a Nestle, which has moved to the high point of trade. They get about 80% of their revenues coming in from urban India as well. So that stock's doing well. Alongside that, we have names like Trent, etc. So we'll keep an eye out on all of this. But let's again, focus on earnings. Once again, we have Punjab National Bank. The third quarter slippages came in at a 38-quarter low. Net interest margin too came in at a 10-quarter low itself. Deposits, however, have risen sequentially. Ashok Chandra, who's the MD and CEO of PNB, joins us to discuss the numbers. Thanks a lot for joining in and taking these questions. So let's talk about both slippages and the NIMs itself. Slippages at a multi-quarter low. Where do they go from here? And NIMs, they've fallen to a 10-quarter low as well. The question is, with the RBI expected to cut rates in the upcoming policy, where do these NIMs go from here?
Good morning, and just to give me some time before I move forward, I express my sincere thanks to my 1 lakh plus employees, starting from armed guards to service staff to my entire officers community, customer service associates, 18 crore plus customers and all the investors for supporting us and reposing faith in Punjab National Bank. Now, coming to your specific point, one thing which you have already mentioned is the slippages have come down. And this slippages, which is around 0.68% of our total portfolio, I think definitely this ratio is going to continue, and we will be below 1% in the slippages front. We have robust slippages monitoring system in place, and I don't think any further the improvement or further drop will be there in the slippages thing. I think we will be able to contain our slippages. Second important part of coming to the NIM part, before that, the recovery front also, and the recovery which is happening in the interest component and the TW recovery, that has also picked up very well. Yes, in this particular quarter, Q3, there has been some drop in the technically written off account, but still we are able to maintain our NIM between 2.9 to 3%. And there has been a drop of around 7% TW recovery if you compare to the previous quarters. And I am expecting that in Q4, there will be substantial recovery will happen in the TW front, and definitely we will be in a position to maintain that NIM between 2.9 to 3%. I'm very confident about it.
All right. Hi, sir. Good morning, and congratulations on a good set. Where do you see your NIMs headed, though? I'm reading a brokerage note. They are looking at the improving asset yields and the potential to grow faster than the system. So, say for FY26, where do you see your NIMs headed to? Point number one. Also, if you could tell us, what is the credit growth outlook for you? There has been some slowdown for the industry at large. For you, what should you end this year with, and on that base for the next year? Please go ahead.
Yeah, first I will touch our credit growth part. The guidance which we had given, it was in the range of 10 to 11%. But we have already grown up to this quarter by 14.68%. And I'm very hopeful with the credit growth and the credit sanctions in pipeline. We have 1.15 trillion sanctions in hand, and definitely some disbursements are going to happen in this quarter and taking forward in another quarters. So with that momentum in place, I'm expecting that credit growth for the entire year will be in the range of around 12 to 13%. And deposit front also, bank has done very well, and we are one of the few banks who have grown in the deposit higher than the credit. That was one of the concerns for the regulator also, but the absolute number also, if you compare that, there is a growth of 70,000 crore in absolute number in this particular quarter in the deposit front, and in the credit growth also in the absolute number, 50,000 crore growth is there in the credit. So we have grown faster in the deposit and overall, if you see the overall business growth also, it is around 15%. So I'm very hopeful that the credit growth 12 to 13%, and the guidance which we have given in the deposit also 9 to 10%, I think we will outbeat that, and we will be growing at a speed of around 11 to 12% in the deposit also.
All right, 11 to 12% growth in deposits, 12 to 13% in advances. NIMs maintained between 2.9 to 3 odd percent. Could you give us a sense on where you are looking at asset quality? Because we have seen a decent improvement quarter on quarter in both your GNPA and your net NPA. Where is your intended target for these two ratios?
See, we had a very long legacy issues of the NPS, and for the last 3 years, we have brought it down. And I'm expecting that by end of this particular quarter and end of this financial year, the guidance which we have given in the GNPA is 3.75%. I think we will be able to achieve that. And the net NPA also, the guidance which we have given is below 0.5%. And already we have achieved a 0.41, and I think we will be below 0.5%. So we will be achieving all the guidance which we have given in the asset quality front.
All right. Mr. Chandra, it's not just your 1 lakh employees that will be sharing this commentary. Your shareholders as well will be quite happy. But they'll also want to know, what is Mr. Chandra going to do? Does he require more capital? Do you all have any fundraising plans as of now to fuel growth from here on, or are you all comfortable?
See, if you see our CRAR, we are already at 15.43%. And in that CRAR, we have not factored the net profit which has happened in the system up to 9 months. Already around 12,000 crore of net profit has already happened. And I think the end of this financial year, somewhere I think around 11 to 12,000 crore of profit, which will be plowed back in the capital. And we will be very, very comfortable in the capital front. This year already 5,000 crore of QIP we have raised, and 3,000 crore of Tier 2 bond we have raised. And as of now, I don't see any challenge on my capital front. With the growth which is we are planning at 11 to 12 to 13% in the credit front, I don't see any challenge in this particular quarter. And going forward also, I don't think any capital raising is required at this moment.
All right, just before we let you go, if you could give us two numbers. One is your outlook on your CD ratio when it comes to, rather cost to income ratio, not the CD ratio. And the second one is if you could give us a sense on your return on assets as well. If you could give us the aspirational numbers on both cost to income and ROA.
Yes. Cost to income ratio, yes, I think PNB is a little bit higher among the 12 public sector bank if I compare. We are at around 54%. And I don't think immediately in this 1 quarter I will be able to reduce this. But I think going forward in 25-26, definitely we will see that we come out with some strategy wherein we can reduce this cost to income ratio. And I think that is one aspiration which we are all having at that top management level also, that can we bring down to below 50%. And it is a very, very ambitious goal. And we will come out with the action plan in the 25-26 financial year. But this year, I think we will be holding to between this 53.5 to 54%.
Okay. And ROA?
ROA, yes, we are at 1% plus. And I am very confident that with the recovery measures in place, the activity which we are happening in the recovery front and containing the slippages and the 97% PCR, which the bank is holding it. So today, any recovery which we are doing it either in the gross NPA or in the technical write-off, I think this is adding to my bottom line. And I'm very hopeful that ROA definitely it will be 1% plus.
Okay, all right. Appreciate you joining in, sir. Thanks a lot for joining in. You're sounding very optimistic about the future. We're going to hold you at all these numbers. We wish you well, and we'll catch up with you sometime during this quarter or the end of it. Well, for the time being, we slip into a short break, come back, continue to focus on markets and stock-specific action. Welcome back. Well, the markets are recovering as we speak, and that's good news. We have come off close to around 80 points on the low point of the day. Bajaj Finance came out with a rather good set of numbers, and the street seems to be quite optimistic on the prospects. I'll tell you what, the stock actually has been a relative outperformer in comparison to what the Nifty has done. We're talking about the markets being weak. Guess what? The stock is up close to around 10% in the last 1 month or so. Even metal stocks, yes, the metal index is under pressure because there is uncertainty. But from the day's low, I think the metal index itself has cut its losses. It was down, I think, close to around 4%. Now it's down 2.5% or thereabouts. The problem is ITC Mangalam, it's put on a good amount of weight in the last few sessions. It's giving up some part of what it's put on.
Just
a little
some
bit.
weight shedding is what's taking place out there. But if you look at, a couple of names, you spoke about Bajaj Finance.
Yeah.
It could also be a proxy play to the urban consumption theme.
Indeed.
Because if you are, buying some electronics, etc., consumer loans is something that the street keeps an eye out on. And if you're buying consumer discretionary, you have Voltas. Just look at Voltas. It's a 5% up move that we've seen in the stock. It's a bit of an underperformer from the past itself. And if you have to play this theme, and Whirlpool is a seller when it comes to the promoters itself, then how do you play it? You play it via Voltas. That's the only player.
Just one more quick stock, Mangalam. Aarti Industries and the chemicals pack as well. From the word go itself, Aarti Industries actually was underperforming. It was down close to 5%. That's recovered. That's in the green as we speak. Tells you the kind of move about some of these chemical-related names. PI Industries was doing well, UPL was doing well, and now you have this one as well joins the list. We'll wrap up on this edition of Chartbusters. Don't go anywhere. The team of Trading Hour comes up next.